Hey everyone, Peter from the future here, and I'm just sitting down to edit the video. I noticed Jane's audio quality is a little bit off, so I wanted to make a quick video to let you guys know that I'm using the full audio track from my mic. She's going to sound a little bit quieter than she normally would, but the quality is still there. It's just there's a bit of a volume difference between her and myself. Hope you guys can bear with us through this. It isn't that bad, but definitely noticeable. So just wanted to let you know. And I've always wanted to do one of these cool intros into the video. Anyway, okay, let's go.
Earlier this week, RBC released their updated housing market forecast, calling for a historic market correction.
So, we wanted to highlight some of our thoughts on the article and also decode some key points from the release. So let's get started with this section from the introduction of the article.
The first signs of a market correction emerged soon after the bank initiated its rate liftoff in March. We expect the downturn will deepen in the coming months, with both resale activity and home prices reaching lower levels than we previously anticipated. We project home resales to fall nearly 23% this year and 15% next year in Canada.
Okay, so a few key things to understand here. Number one, we're hearing a lot of talk right now about sales decreasing, and this is definitely true. But something that's really important for you to understand as a consumer is when they're referring to sales, they're actually talking about the number of transactions, not prices. This is a key distinction because from a technical standpoint, the volume of transactions has little to no impact on pricing. What you need to do is actually pair the volume of transactions with the number of listings that are actually on the market. And these two stats relative to each other are going to give you a much more accurate picture of where prices are going.
So in other words, low listings plus low sales equals balance or scarcity, where high listings and low sales equals an abundance of listings all competing against each other, dropping their prices, resulting in a lower sales price. Okay, let's move on. The national benchmark price to drop more than 12% from peak to trough by the second quarter of 2023. We expect local outcomes to vary widely, with the priciest, more interest-sensitive areas facing larger declines and relatively affordable markets showing greater resilience.
Okay, here's where we're talking about actual prices. And as we go through this article, I want you to remember just one thing. National home sales is far too broad of a scope for you to be comparing to your local market.
Case in point, the Durham region. As a suburb of the GTA, we saw an abnormal amount of people coming out our way as more and more people wanted to get out of the city. And as a result of that, we saw some of the most aggressive price increases throughout the GTA. Based on this evidence, it's safe to assume that we'll also see some of the most aggressive price declines throughout the GTA. And in fact, we've already seen average sales prices come down over 20% across Durham region. Naturally, our market being more volatile, will be reacting differently than other suburbs across Canada that didn't see the dramatic increases that we did.
The outsized 100 basis point rate increase our central bank delivered on July 13th will no doubt speed up the market's cooling phase in the near term. While the move won't necessarily result in a higher terminal point, we still expect the overnight rate will reach 3.25% by October. It's a big bite for borrowers to swallow that will spoil or delay homeownership plans for many buyers. The hike took variable mortgage rates roughly up to par with fixed rates, effectively shutting the last window of super cheap borrowing costs available to buyers.
Now, the key point here is twofold. So number one, money being more expensive to borrow means that buyers are qualifying for less naturally, and less buying power equals lower prices. Number two is people on variable rate loans. Now, they don't share the statistic here, but nearly 50% of home buyers throughout the pandemic window in Canada opted for variable rate mortgages. When you pair that with record-breaking sales prices, I think that we're going to see a lot of home buyers out of necessity either need to move in with family and rent out their places or sell because they can't afford to keep them anymore. In fact, we've sadly already started to see this trend in some parts throughout the GTA. Well, we project resale activity to cumulatively decline more than 20% in every other province from all around record levels this year and next. We think prices will be more resilient in the more affordable regions of the country. We project prices to slip less than 3% in Alberta and Saskatchewan and between 5 and 8% in the majority of other provinces by the first half of 2023.
As we discussed earlier, the markets that remain more stable are going to be the ones that didn't go on the crazy runs that we saw in parts of Ontario and British Columbia. But ultimately, I think what we're seeing here is an affordability issue above all else. Buyers need to be able to afford the homes they're buying. And if they can't, then sellers are going to need to lower their prices until the point where buyers can again afford to purchase. But right alongside affordability comes buyer sentiment. And buyer sentiment plays a major role in the market. As buyers hear more negative news about the housing market, they may be inclined to pull back, spend less, or just altogether wait. And when you pair this with the increased cost of living, even if it is just temporary, I think this is going to put a lot of buyers on the sidelines, which is definitely not where sellers want them to be.
So what does this all mean? Let's talk to the different groups out there.
First-time home buyers, I'm so excited to say that this means you can finally afford to wait. Now, I'm not saying not to buy, but what I am saying is you can finally wait for the time to buy that's right for you. And you don't have to worry about the market continuing to appreciate and your savings being worth less. So wait, talk to your family, and when the time is right for you to move, you can rest assured that the market is going to be a lot friendlier to you than it would have been a few months ago.
Sellers, take a deep breath. Remember, everything is relative. If you're going to be buying and selling, you may not be selling for as much as you would have a few months ago, but you're also going to be purchasing for less. Just remember that in a market like this, it's important to sell your house first and make sure that it's marketed and presented properly.
All right, investors. Now, the quick and dirty here is I'm definitely not looking to buy a flip property, but what I would be looking at is potential buy and hold opportunities, as long as it meets one criteria. It has to cash flow. In the meantime, I'm going to sit on the sidelines and wait. I think we're going to see a ton of opportunities coming up over the next few months, and I want to have my cash ready. That way, when the opportunity does come up, you're ready to jump on it.
So no matter what situation you're in, it's really important to remember not to operate out of fear. Use the market to your advantage. There's always silver linings in real estate. And if you have any further questions, don't hesitate to reach out to either Peter or myself. We're here to answer any of your questions.
Thank you so much for sticking around to the end of this video. Please give us a like and leave us a comment letting us know what other videos you guys would like us to talk about, or if you want to get a little more in-depth on this. And if you want to see more content and make sure you're staying up to date with what we post, hit subscribe so you don't miss another video.